We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. I'm Mark Elliott. Glad you are with us today. And I do this at the start of every show. I hope you remember it. But the idea is, if you want to learn more about Brian and the team, all you have to do is go to the website, deckerretirementplanning.com. But I bring this up because they have put 12 different things you can download. And it's really just there for your information. There's no cost. There's no obligation. There's nothing. It's just information for you to learn about retirement. One of the cool things is you can get Brian's book on retirement, the Decker Approach book, the 3 Principles of Retirement book. There's a checklist challenge, sample income plan. That's just a quarter of the things you can get. And so it's deckerretirementplanning.com under the heading of Safer Retirement Education, or all those options you have. Download any or all. It's kind of your choice. It's really there for your information so you can learn more about retirement, some of the things to prepare yourself for that situation. Of course, you can always call the team. There's no cost. 833-707-3030. No cost, no obligation, no pressure, no judgment. Brian never did tell me. He goes, I can't believe you're still holding onto your Blockbuster stock. And I'm like, it's coming back. It's coming back. I'm going to hold on to it. There's no judgment. 833-707-3030 is the number. We'll give that number throughout the program. And today, Brian, you and Brad are going to get into the don'ts. Don't do this for retirement. That's going to be kind of a fun show.
That's right. We'll mix in some do's also, Mark. But okay. Let's start off, Brad, with a great analogy. And you and I have talked about this. In climbing Mount Everest, there's the casualty rate going up the mountain. It's 8x going down the mountain than it is going up. People take all kinds of planning going up the mountain, and they have their plans in place. They execute. Coming down the mountain, you don't use the same strategies. Most people don't plan, and there's 8x, 8 times the amount of casualties coming down the mountain. That analogy works in retirement. Brad, in your 20s, 30s, 40s, and 50s, if the S&P, the markets drop 30, 40, 50%, no big deal, because your work is giving you the income you need. You've got time on your hands for the markets 3 to 5 years to recover. And every 2 weeks, you're kicking in money into the market. So you actually benefit from that market drop in your 401k. Now let's switch it. You're 65 years old, you're retired, your portfolio is there to finance your golden years of retirement, and that drops your portfolio 30, 40, 50%, and you're drawing income from a decimated portfolio. That is a different story altogether. So the strategies that got you to retirement, which is called accumulation strategies, those are not the strategies you use in retirement. Those are called distribution strategies. So Brad, tell us why we shouldn't use a traditional asset allocation plan 60-40 in retirement.
Yeah, for sure. I mean, there's all sorts of discussion right now about that 60-40 portfolio. I think 2022, for those of us that looked at our portfolios and saw that they were down during that year, it's it really called into question a lot of the boilerplate recommendations people are given by traditional financial advisors, not specialists, with how to manage a portfolio in retirement, because a 60-40 classic retirement strategy really did not do well. I think a couple things that are top of mind for me, and I'm sitting down in my office and looking at an existing investment strategy that someone was told was appropriate for their stage, their financial life. There's a few that I bring up. So the first one is just that longer lifespans. You think about the concept of using a 60% equity, 40% bond portfolio by a traditional advisor at some of the major banks and brokerages. And that was the same strategy that my clients' parents were using. And it's been like the classic bread and butter of retirement investment advice for a long time. And it's a different climate. I mean, if someone's living on average 10 years longer, 15 years longer than their parents, and certainly longer than their grandparents, well, how could the investment strategy that worked for someone back then be the same investment strategy that's appropriate for them today? So I think longer lifespans is one that sometimes people don't always take into account when devising a portfolio that's meant to last a lifetime. I'll probably give maybe two more here. And Brian, you can, I think there's 5 or 6 that I have in mind, but the next one is very front and center for a lot of retirees, and it's just inflation. Inflation concerns. We are no longer in that post 2009 era with 0% inflation for a long time. Inflation is a very real concern, ought to be a very real concern for retirees. And oftentimes, as people are getting older, their advisor will tell them that they need to put more and more and more into low yielding bonds, things like treasuries and even worse, bond funds. And in the name of safety. But at the same time, if that's sacrificing their exposure by increasing their exposure to something like inflation, well, that might be worse than taking on more portfolio volatility. So inflation is a material concern for me, especially at our firm where, Brian, you and I focus a lot on people's spending habits and their spending needs. So inflation concerns coupled with that longer lifespan is two of the biggest reasons. I think the last problem I have with the 60/40, and this was very specific to that 2022 era. And I think any potential market downturns probably shed light on this concept. And it's that in theory, we like to think about a portfolio averaging 7, 8, 9% per year over long periods of time. But that's in theory. In reality, it hits every single number but 7, 8, 9%. You have to be up 13, up 15, down 27, down 30. You're going to hit every single number but that 7, 8, 9, or 10% per year at average that you're looking for, that your advisor puts in front of you when you're in a meeting. You hit every number but that. And that market volatility, especially using 2022 as a case study, it's just agonizing. You might have your Social Security coming in like clockwork. That's nice, maybe a rental or pension. But if you're drawing money from a set of financial assets that are fluctuating in size literally daily, it is not a comfortable thing to spend from, in my experience. It's just not something people want to be staring at and driving decisions based on market performance, whether they should go on that cruise that they promised their family the year before. So I just think that when people have that much exposure to market volatility in a typical 60/40 portfolio, it just doesn't lead to what I think is the best, most highest caliber life that they spend a lifetime saving for. Anything you'd add to that, Brian?
Yeah, I wanted to, the number one fear in retirement is running out of money before you die. And I believe it's linked to the pie chart, the 60/40 portfolio. You can't know looking at a pie chart how much money you can draw. So people guess, and they guess low. So when they come into us, they happily get a nice bump in their income. But I just think that you don't use a pie chart because it was never intended to be a retirement plan. The other thing is a 60/40 portfolio assumes that bond funds are a good investment. They're not. You hit on that, Brad. I just wanted to point out that we had a bull market in rates from 1940. The 10-year treasury was at 2%, went up to almost 15. Whoever owned bond funds during that 40-year period lost a ton. And then interest rates declined from 1980 down to 2020, August of 2020. Interest rates went from 1980, almost 15%, down to 0.47. Whoever was recommending bond funds when you're at 0.47 on the 10-year treasury, hopefully they weren't fiduciaries, because that is seriously not even coherently logical to have a bond fund that close to zero. Because when interest rates go up like they did since August of 2020, the last 4 years, people have lost over 35% of their principal in these bond funds that bankers and brokers told them was their safe money. And there's 35 trillion reasons why interest rates may not be going lower. You've got these bond auctions that they've got to move all these massive amounts of treasuries. And to think that rates are going lower, yes, the Fed is going to be lowering their rates. The 10-year treasury has dropped from 5%. It's right now at 3.6. Rates have come down, but these bond auctions are failing. And there's a lot of research saying that interest rates may not follow the Fed rate cuts. So we'll see. The other thing is buy and hold. When you've got 60% of your portfolio at risk in retirement, that's insane in our opinion. We're fiduciaries. We're a math-based firm. Our clients have about 25% of their portfolio at risk. You take a massive hit, 30, 40, 50% in the markets when you've got 60% of your portfolio exposed. That is not the right thing to do. And a lot of people will be forced back to work, just like they were in 2008 when the markets dropped so much, 50%. From October of 07 to March of 09, that was a 50% drop. And the last thing is the Monte Carlo simulations, in my opinion, are a joke. Here, Mr. and Mrs. Client, you're retired. Here's your plan. You have an 85% chance of success. Well, that can't make you feel good because these black swan situations like 2008, they roll through every 7 or 8 years. For one reason or another, there's something else that causes the markets to go down 30, 40, 50%. It's not the same thing each time. And so we just want to point out these are the don'ts. And the first don't is don't use a pie chart for a retirement plan because it's not.
So if you have questions about this, you're like, well, I don't know about all of this. I'm not sure how this all fits into my retirement, and I'm not really sure. I think I've got enough. I hope I've got enough. I don't really know. Great opportunity to sit down with the team at Decker Retirement Planning. It's 833-707-3030. No cost for this. It's complimentary. 833-707-3030. The idea is find out where you are. Quit procrastinating. Let's find out. Maybe you can't. Maybe you could have retired 5 years ago. Don't even know it. Maybe you need to work another year or two. Don't know it. They don't know until you reach out to them. 833-707-3030. Brian and Brad today talking about the things you want to avoid in retirement, but also they're going to get to some of the things you really should think about in a positive way when it comes to your retirement. And so you think about it. When you're in your 30s, the markets go down. Great. I'm buying more stuff. Well, when you're in your 60s and 70s, market goes down, and that's where all your income is coming from when you retire. Not such a great scenario. So how do you plan for that? The team at Decker Retirement are here to help. 833-707-3030. Back with more of Safer Retirement Radio right after this.
Legacy planning is more than just numbers. It's about the impact you leave on generations to come. Let Brian Decker guide you in creating a lasting legacy. Call Brian and the team at 833-707-3030 to start your legacy journey.
Who likes uncertainty? Wall Street certainly doesn't. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 3 decades, Brian Decker has seen uncertainty come and go. No matter what the future holds, Brian and the team at Decker Retirement can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 833-707-3030 now to meet with Brian Decker and the Decker Retirement Team. If uncertainty is causing you to feel insecure, Brian Decker can help. Call 833-707-3030 and schedule your visit today. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. DeckerRetirementPlanning.com to learn more. 833-707-3030 if you want to chat with the team about your situation, find out where you are, get some clarity into your retirement picture. 833-707-3030. I'm Mark Elliott. Glad you're with us. Brian and Brad today talking about the things that we really don't want to do when it comes to our retirement. They're going to get into some things we certainly want to do. But, Brian, one of the things I always think is interesting, when the 2008, the Great Recession, right? 07 to really March of 09. I didn't really care. I wasn't close to retiring. And I thought, well, I guess my portfolio is buying stocks on sale right now. That's a good thing. But if I'm retiring and I'm almost 65, if I was going to retire, say, this year, and I had all my money sitting in the markets and the markets went down, that's a totally different situation, isn't it?
That's right. if your plan, and I'm going to say this twice for emphasis, if your retirement plan requires the markets to keep going up, your plan is at risk. You are highly probable that you'll have to go back to work because markets cycle. They do not trend. If you think that markets trend up over time, that's not right. Markets cycle. So in the last 100 years, there's been 4 times that the S&P 500 has hit a market valuation of 30 times trailing earnings, just 4 times. One was 1929, and markets traded flat for 17 years. The second time was 1964, markets traded flat for 18 years. The third time was November of 1999, markets traded flat for 14 years. The fourth time is just recently. We hit November of 2021, we hit 32 times trailing earnings. And with 100% historical veracity, we are hoping for the best, but we are planning from the worst. And that is, we are expecting the markets to trade flat for the next 10 to 15 years. That's devastating for people in retirement. And so what we do is put plans together that don't require a positive stock market. For example, in our portfolio structure, we don't have a 60-40 blend. We have a 75-25. Only 25% of their portfolio typically is at risk. We'll talk about that in a second. But Brad, go through how the different structure of the portfolio is there and how we don't require an up stock market. We can do well if markets go up or down in buckets 1, 2, or 3. We have 3 different markets that we're investing in buckets 4 and 5. And the risk bucket, we have a 2-sided strategy. So Brad, go through how we protect clients so that they don't require an up market to do well.
Yeah, something I really like to tell my clients that's along that same vein, Brian, is that no advisor out there can control the returns. The market's going to control the returns. What we can control as financial advisors is the risk. So you can't control the return profile or the return cadence, but we can control the risk you take in order to attain the returns that we figure out are best suited for that individual client. Now, what I mean by that is that we have to be really thoughtful when designing a plan, a portfolio that is hinging on a client's intent to draw money out of it, a distribution plan, as you said earlier. So we're really thoughtful around where do we incorporate risk, if any risk, into different sleeves of our client's portfolio. So you think about first, any money that is going to be at risk. Right? Everyone knows that they need a long investment horizon in order to tolerate any of the wiggles that the market might bring forward. Right? You can't have everything in a single stock and require that money to make a college payment 6 months later. They'd be absolutely silly. While it might pay off in your favor, you're taking a ton of risk to have that happen. So during our planning phase, what we are really good at, I think, is helping clients thoughtfully think through how and when they want money to come out of their portfolio. And that's where we'd start with like bucket 1. Think about the slam dunks over the last couple of years. While money market rates, savings accounts rates were topping 5% for a period of time. They're coming down slowly right now, but topping 5%, that's where we want to park money that a client's going to spend for the first 1 to 3 years. And that way, to your point, if we go through a material market downturn, say 2008 or even 2022, that portion that they're drawing from for 1 to 3 years is immune. It's protected against that loss. If anything, they're going to have a near guaranteed return on that. A savings account will pay them a yield that was planned for that first 1 to 3 years, even in the middle of the deepest, darkest depths of 2008. So you're thoughtful around that. You have some fixed guaranteed wins on the sources you're going to draw early on. Now, as you go down the line, our listeners aren't going to have our plan in front of them likely, but as you go down the line, you start to get to increasing lengths of investment horizon. And that's where you can either take advantage of what's called a liquidity premium, where if you don't need the money today, but you really want it in 3 or 4 years, well, you're going to be able to command a higher rate of return without taking risk. So in those cases, we might use some fixed rates of return there. Highest rates right now, 3 to 5 year time frames, we're still looking at over 5% guaranteed for that period of time. So getting some really solid wins over a 3, 5, 7 year time frame. Once again, emphasizing that we don't want to have any drawdowns beyond just income distribution because of a market crash. So drawing again from a source of funds that's protected against losses. Now, as we go further down the line, that's where we get to where pieces of a portfolio that are planned to be used for distributions over longer periods of time, you can expect higher rates of return, but you still want to have some protection against losses there because of the risk of drawing from an account in the middle of a downturn. So as you get further and further down the line, I think it's important people become extremely cautious around the risk that they take. Now, last but not least, for the money that is really not needed for what is classically a long investment horizon, 10 years out, 15 years out, 20 years out, all of my clients have some portion of their portfolio that they very likely do not need for sometimes 20 years. That's where you can take risk. That's where you can have a piece of your portfolio suffer through the agony of a 2008 type of crisis, or you can use other strategies as well. But when you have a long investment horizon, and we know very clearly that it's not needed for a long period of time, that's where we can take risk and take advantage of the higher rates of return that the market can serve up.
That's right. Now, I just want to add to what you said. So we have the portfolio structure. So in the laddered principal guaranteed accounts, we've got fixed rates in buckets 1, 2, and 3. So in years like 2022, when the S&P is down 19, NAS down 33, bonds down 20, commodities were down, everything was down, those accounts made money. Those are CDs, 3 and 5 year CDs. Those are money market accounts that are earning 5%. Those made good money. It doesn't matter if markets go up or down. So we diversify and have those locked in. Buckets 4 and 5, we're investing principal guaranteed money and allocating to whatever market's going up between stocks, bonds, and commodities. So in 2000, 01, and 02, when the S&P is down 50, NAS is down 70%, those accounts did very well. Bonds and commodities did well. In 2008, when the S&P from November of 07 to March of 09 is down 50%, those accounts did well because bonds were up over 20% in 2008. So it's just a matter of making sure that those principal guaranteed accounts can do well, whether markets go up or down. And then when it comes to the risk bucket, we've got a two-sided strategy because with momentum strategies in the risk bucket allow us to buy whatever is going higher. In 2000, 01, and 02, the S&P was down 50%, NASDAQ down 70%. And yet during that 3-year period, real estate through the REITs, gold, silver, energy, pharmaceutical, biotech, healthcare, all those stocks made good money, double digits for each year for 3 years. And then markets exploded to the upside. So you jump into semiconductors in March of 03. For the next 4.5 years, semiconductors, technology, small caps, emerging markets all did very well. And then going into 2008, you were stopped into cash for 2008, with the exception of treasury bonds, which were up over 20%, like I said. So the momentum strategies are able to do well in up markets and down markets. So when the S&P is trading higher, our risk strategies, we've hand selected 5 different momentum strategies, cherry picking the best parts of the market. And when markets go down, we have an offensive defensive strategy. We pull the offensive team off the field when the S&P drops below its 200-day moving average and starts a downtrend. That's when we put the defensive team on the field, enabling us to make money in down markets. So these are designed to do well in up or down markets. All parts of the portfolio are able to do well in up markets and down markets. And so that is a retirement plan. And a great litmus test was 2022. S&P down 19, NAS down 33, bonds down 20, commodities were down, with the exception of energy. So these momentum strategies were able to make money in 2022 when most people lost over 30%. Our strategies, our retirement plan, our portfolio that we had for clients that had all those pieces in place, they were able to make money in 2022. Not a lot, but we were one of the few firms that made money in 2022.
Yeah, Brian, if I could just add one more thing here, and it just comes down to what lens are you putting on your portfolio? What lens, by what lens, like what's the purpose of this? Is this money meant for long-term growth, long-term accumulation, give it to kids and grandkids down the road, be twice as big as it is today? Well, you know what? Fine. Maybe you buy and hold and gray. But our clients are looking to get a little more out of their assets. They saved this money for a reason, is a default opinion that I hold anytime I'm sitting across from someone. And my job as a CFP is to figure out what that reason is and align that reason with their portfolio strategy. And it makes me sad how many people go through retirement without having that be a discussion that's front and center. They're investing their money in alignment with supposedly their risk preferences. Right? They're willing to lose a certain amount in order to gain a rate of return that they tell their advisor is acceptable. But that just is so far beyond what people actually save their money for. It's just not even in the conversation of having a smooth income stream that is knowable and a withdrawal order that makes sense, that's tax efficient, and understanding how much risk they're taking and where and why it's there. There's just so much that's left unaddressed when you're just looking at a pie chart with supposedly 60% in equities in a particular day.
Yeah, so it's really at the end of the day, I mean, why are you taking risks that you could lose 40 or 50% of your portfolio if you only need 5% profits every year, basically, or gains? Most of us are taking more risk than we even need to take. This is where the team at Decker Retirement can really help you figure out what is your risk level, right? You've all heard the moderate, conservative, aggressive, or whatever. Really, if you said, I could lose 20%, it's $200,000. Well, no, I can't lose that much. It is about the dollars, the actual day-to-day living and what we want down the road. What is your portfolio for? What's it supposed to do for you? Brian and Brad, the team at Decker Retirement, here to really help guide you, give you some focus, some clarity into this. 833-707-3030, again, is the number. No cost to chat with Brian, Brad, and the team. It is 833-707-3030. Might be one of the more important phone calls you make. Might as well take advantage of this opportunity. No cost to you. 833-707-3030. Brian and Brad back with more right here on Safer Retirement Radio right after this.
Do you need help assessing your risk tolerance or adjusting your portfolio to help reduce your fees? For help with income planning, set up an appointment with Brian Decker today. Call 833-707-3030. That's 833-707-3030.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. I'm Mark Elliott. 833-707-3030. If you have questions, you have concerns, you're not really sure, boy, I think we can retire, I hope we can retire, I don't really know, find out. This is your opportunity. 833-707-3030. Complimentary conversation you can have with the team at Decker Retirement. 833-707-3030. All right, Brian, you and Brad have had a lot of discussion so far about, don't do the old original 60-40 plan. Certainly didn't work in 2022 when it was only the third time in history, actually, 1931, 1969, and 2022. Stocks and bonds both down in the same calendar year. But the rules that used to work in the 90s, for example, really don't work in today's retirement world. So we're talking about things that we really don't want to do, and then you obviously sprinkle in things you would like to do. So where are you going next?
Now we're going to talk about insurance. So Brad, let's do a deep dive in long-term care, whole life, and the different insurance. I feel like, and Brad, you chime in here, but my take on insurance is there to get people to the finish line, which is retirement. So if they have insurance, we use it in a couple of different ways. If they have insurance, by retirement. If they have it, keep it. If they don't, by that point, they don't need it unless there is risk. There's income risk to one of the spouses, one of the partners. So here's an example. Let's say that one of the spouses has a huge 6-figure pension that dies with them. Well, that puts their significant other or their spouse at significant risk, income risk. And so we want to buy and make sure we have whole life, non-cancelable insurance on that person's life. Now, we do estate planning with insurance too, Brad. Let's not go there yet. But what other reasons are there to have insurance? One, to get them to retirement. Two, income replacement. Any other reasons to have life insurance before we jump into long-term care?
Let's kind of stick with the core. There's off cases, I think, for any time you're using some form of insurance. There's applications for it where it makes sense, but I think you're by and large correct. But let's just keep going with that.
Okay. Now let's talk about long-term care. We're licensed to sell it. We rarely do because there's some qualifications and definitions we need to make, Brad. And one is the statistic that's out there to scare people. 70% of Americans will spend time in a long-term care facility. Well, if you check the US Census, that number is 16%, not 70%. Well, we've done some research and found that the reason that they count 70% is they count even one day in hospice. Well, if hospice comes to your home, which they do, that jacks the number up really high. The actual number is about 16% of Americans will spend time in a long-term care facility. And we define long-term care risk as the risk that one spouse bankrupts another spouse. So for example, when both spouses are alive, there is long-term care risk by that definition. When one spouse has already passed, by that definition, there is no longer long-term care risk because you have the entire estate there to pay any long-term care funding. But let's go through, Brad, the different options that people have with long-term care.
Yeah, let's do it. I think you're absolutely right. I love that you brought up the point that I think is kind of confused when it comes to long-term care concerns. You got a ton of people that come through, and it is one of their top concerns is, well, how am I going to pay for long-term care? Everyone has that story of a loved one or friend or parent of a friend that had very high costs, and they're very concerned about how they pay for their long-term care costs or elevated health expenses. And I make sure that I reframe that and say that the real risk here is not that you won't be able to pay your long-term care bills. We cover that separately, but it's actually the fact that there has to, in many cases, be a surviving spouse that has to remain financially viable after the long-term care costs. So any potential need to mitigate that risk could be drawn from insurance. But to me, I mean, by and large, like you said, long-term care is my least favorite license that I have to carry. It's the least favorite one that it's not my favorite product. I think it's very much in favor of the insurance companies for the very rare chance, statistically low chance that someone actually does need to pull from that long-term care policy. It often doesn't cover as much as they thought. So my preferred way, and then I'll let you kind of pick up from there, is just the self-insuring. Self-insuring is definitely my preferred approach, and I know yours as well. As opposed to going out and seeking long-term care. But of course, those other two options, you can use a long-term care policy or asset-backed long-term care, but I'll let you elaborate on that.
All right. Traditional long-term care is another option, Brad, but we just want to make sure that it's right for people. So we just make sure we talk about the advantages and disadvantages of each. And so with traditional long-term care, you have a nice, maybe $500, $600, $700 a month payment. And the premiums are called guaranteed level premiums. And so it gives you the idea, the thought that you just can't cancel those. Well, the truth is you can. In fact, what happens in your late 60s, early 70s, you get something called the letter. The letter tells you that from the state insurance commissioner that your premiums have just gone up by 60%. Why? Because that's the maximum amount allowable. And the state allows it because you are now entering the high premium risk ages for the long-term care community. So the insurance commissioner allows it. But wait, you said you thought that these premiums were not able to be cancelable or raised. They were guaranteed level. Well, they're not. So point one is they're not guaranteed level. You're going to get that letter. And the letter is there to give them that additional premium, but a lot of people will just cancel. They'll get scared and just cancel their premiums. So that's a win for the insurance company. They keep all those years of premiums and they have zero risk because you just canceled. Or you're going to cut your premiums in half trying to get the level to an affordable level for you now that they've jacked them by 60%. Well, that's another win for the long-term care industry because now they have half the risk and they're getting the same amount basically. So as long as you know that those risks are there with long-term care, we just want to make sure that your eyes are wide open by making this decision. Now, we have a saying that those that can afford long-term care don't need it, and those that need long-term care can't afford it. And we see that play out, especially when you get into your ages 60 plus and you want to start searching for a long-term care solution. Well, it's going to be very, very expensive. If you want to start long-term care, you would need to start it usually in your early 50s, maybe as late as your late 50s in order to get the premiums low enough. But that's an option. So we've covered two options. Brad covered the option of self-funding that risk, and I covered traditional long-term care. Now, there's another risk in traditional long-term care, and that is if you have a heart attack and die. You never went into a facility and all of those premiums go away and they are for naught. You didn't get any benefit for those. So if you die from heart attack, stroke, car accident, cancer, whatever, then, and you never go into a long-term care facility, you never used it, all those premiums are worthless to you. There's a money that was spent and you'd got no benefit. So if a client can self-finance that risk, that's better. Now, the third option is an asset-based long-term care solution. This is where you pay money so that you've got use of $300,000 benefit, whether you die or whether you go in a long-term care facility. So this is when an insurance salesman says to you, hey, let's get you that $300,000 no matter what. If you die, you get $300,000. If you go into a long-term care facility, you get $300,000. Sounds great, right? Well, the problem is they have actuaries, very smart actuaries that make sure that it's profitable product for the insurance company. So what does that mean? That means that a big chunk of clients are priced so that that $300,000 is more premiums paid than your benefit. In other words, they price it at over $1,000 a month per person so that when you get into your ages of risk, that you paid more than $300,000 in for a $300,000 benefit. So that's the problem with asset-based long-term care. Another one, the fourth option you have is called a safe harbor trust. So safe harbor trust says, geez, 70% risk of going into a facility. Well, what I'm going to do is I'm going to call my brother, Brad, and I'm going to move all my assets over to Brad so that if when we get into a situation where we have to pay these huge premiums, we won't have to pay. We'll just go on a Medicaid facility. It won't cost our estate anything. And after one spouse passes, then we draw that income back. Two problems with that. One, the IRS is onto this and they have a 5-year clawback provision. If you are diagnosed with something that takes your life within 5 years or causes you to go into a facility within 5 years, they get to claw those assets back into your estate and bill them. The second problem is kind of big, and that is my brother Brad can say, hey, Brian, thanks so much for those assets. I think I'll keep them. And legally he can because we moved those to their name, to his name. So those are the major options you have for long-term care. We highly recommend self-financing that risk. Now, we could make a commission on selling long-term care premiums. That's the difference between being a fiduciary and not. We recommend most all of our clients, to self-finance that risk. Brad, anything else on that?
No, I think I would just add that I guess there is one thing I would add. It's just when it comes to that asset-backed side, I mean, the safe harbor always sounds a little wild to me. It just sounds like really crazy, very intense. I'm sure some people have had some applications where it made sense. That one just always sounds nuts. If I had to pick one beyond self-insuring, the asset-backed is a category where I think it provides, it's not the perfect solution, but if someone truly is concerned about this and they just have bad experience with it and they just know how much it can rock someone's world to go through this and they don't want to upend their life and they want to, perhaps just make sure that they're not a burden on their kids or grandkids. The asset-backed approach, I do think is doable. There actually are some interesting ways of allocating funds there that provide the option for the long-term care hedge that someone might want, but they're not just forking over money to an insurance company every single year with high fees, and it can have some decent rates of return. So I think that's the one thing I would add is that of the long-term care options that I don't love maintaining a license for, I think the asset-backed is one that I've actually seen some pretty reasonable ways of going about it that are quite a bit better than just the guaranteed level premiums you were talking about because of the drawbacks of the letter that they get later on in life.
So really the question is, how are you going to handle that situation? It's nothing that we want to think about, but it is certainly part of the safer retirement process that Brian, Brad, and the team will walk you through. It's about income. It's about investments, taxes, health care is a part of that, legacy planning, Social Security decisions, got to make them. When is the right time? It's in the income part. What about Medicare decisions? It's in the healthcare part. So a lot of moving pieces in retirement that we really haven't had to deal with all of these while we were working because maybe our employer took care of healthcare. We had money going into the 401k. Markets went down. That's okay. We're buying more at a discounted rate. It's different in retirement. That's why I think it's so important to have really, in a way, like the big Fortune 500 companies, having a chief financial officer to help guide you. That's what Brian, Brad, and the team at Decker Retirement can be for you. They could be your CFO. 833-707-3030, just to find out if they can help. They give you some clarity into your retirement picture. 833-707-3030. Again, it's complimentary, no cost to you. 833-707-3030. Back with our final segment of Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. Back with more right after this.
Maximizing your deductions is like finding hidden treasures in the tax code. Let's navigate the financial landscape together. Call Brian Decker at 833-707-3030 for guidance.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. I'm Mark Elliott. Again, DeckerRetirementPlanning.com is the website to learn more about Brian, Brad, and the team. Find out where the offices are. There's a lot of information on the website that could be pretty beneficial to you. Obviously, you're going to have the number, address, all that kind of stuff. Decker Retirement Planning, under the heading of Safer Retirement Education, there's all those things you can download, including Brian's book on retirement, The Decker Approach. And it's really things that you maybe want to learn more about, the financial world, the retirement world. How do we fit into this? What do I need to know? There's a checklist challenge, a sample income plan. It's all on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. 12 different things you can download, all there for your information. 833-707-3030 if you want to have a conversation, get some clarity into your retirement picture. It's a great opportunity for you, I think, and there's no cost, so it's just, is it worth your time to have a conversation about your future? 833-707-3030. 30-30. All right, Brian, you're down to your final segment. You've got 11 minutes left. Well, you got 10 minutes left now to wrap this all up, because I know you're going to talk about some things that we really should do as well in retirement.
We're going to still say one more thing that you shouldn't do, and that's concentration, where you have an overweighting of a single company in your portfolio. And I just want to bring up this Clint Eastwood Dirty Harry scene again, because it cracks me up. So they're in a gunfight. Clint Eastwood is shooting at all the bad guys. They all drop like flies except for one guy. And he puts his boot on his neck, points the 38 right in his mug and says, with all that firefight, I don't know if I shot 3, 4, or 5 shots, but I don't know if I've got one more in the barrel. Well, punk, do you feel lucky? And so I look at these people who have massive amounts in one stock. And let's say when I first started in the business in 1986, there was a saying on the street called "What the heck by deck." That was Digital Equipment. DEC was the stock symbol. Mark, do you remember that company, Digital Equipment?
I do not.
All right. Well, it was very, very much in favor. A huge technology stock, couldn't go wrong. People had massive amounts of their retirement in their portfolio. And guess what? It went belly up. How about keeping a massive amount of your portfolio in a blue chip called AT&T or any of the baby bells?
I can keep it in Enron. I'll be fine.
Enron was another example. Or how about Polaroid or Kodak? How about Sears or JCPenney? These are blue chip companies. Or GE. GE was flat and made no money for 23 years. Even Microsoft, a great company, that was flat for 14 years. These companies like NVIDIA and Apple, who else? Amazon, they have capitalizations of 2 and 3 trillion times. Market capitalization is shares times share price. When you get into $2 and $3 trillion range, you mathematically cannot continue to grow at 20%. ExxonMobil is a pretty good sized company. They have a market capitalization of $40 billion. So if you're going to grow a $3 trillion company by 20%, you're creating a company bigger than ExxonMobil every year. It is impossible, can't be done. And yet people have a huge portion of their portfolio right now today in Apple, Amazon, and NVIDIA, expecting these trees to grow to the sky. It ain't going to happen. So Brad, what do you recommend when you see market concentration with your clients?
Yeah, a couple things I point out to them is that right when people start to get excited about their stock is right when they probably ought to be selling portions of it. And where this is coming from is that just because a stock has appreciated, 10, 20, 30%, or perhaps even 2, 3, 4x their original investment, that stock is directly, maybe even exponentially less attractive because it's more expensive, right? I mean, that's the Warren Buffett quote. The stock market is the only market where when things go on sale, everyone runs out of it. But the opposite is true as well. The more expensive these popular holdings grow, the more attention they receive. And that can cause kind of this market-driven frenzy or a tolerance for risk that is not really in line with the return profile. I mean, like you said, going from a $3 trillion company to a $6 trillion company is substantially harder than going from a $1 billion company to a $2 billion company. And so the more value, the higher price these stocks are, the more increasingly difficult it's going to be for them to get to that next level. So I do make sure that my clients, if they're looking to maintain a concentrated position in a stock, that they're aware of the fact that their favorite stock has probably grown to be their favorite, directly in line with it being less and less likely of it being able to produce the next leg of returns that are in line with its last leg of returns. So that's one thing. The second one, though, is I'll be the first to say I'm not going to be able to tell someone whether one particular stock or not or another is going to continue to go up in value or down in value. And I hate being the one that would tell someone to exit a position and then watch it go up 2 or 3 times over the next few years. So instead, I take a little different tack. I make sure they're aware that I'm not going to be able to predict that any better than they are. Right? And instead, what I do is if someone has a concentrated position, I make sure that they understand where it sits in their plan. And that's where I come back to what I was saying earlier, where if someone needs this holding as a crucial aspect of their long-term financial success, the concentrated position is not going to reward them with the return profile in line with the risk. And if that risk of loss of, like you said, a Polaroid or a JCPenney or a Sears causes them to not be able to retire comfortably anymore, we need to fix that. I mean, just hands down, that has to be addressed. That has to be brought front and center to where if they want to maintain that concentrated position, they need to make sure their resume is fresh when they're in their 70s and 80s. Because if that stock does experience some creative destruction or something where, like you said, the Kodak going the way of the dodo as soon as the iPhone was invented or announced in 2007, a client needs to be aware that they need that company for their financial success. And so if they do like it, it's going to fit in their plan in a place where it's not needed for a very long time. And the concentrated position is very, very dangerous if someone is using it actively as a source of income with the expectation of near-term gains. So you have to plan very long-term. So that really is kind of my initial take is I'm not going to tell someone that they can't hold that position. But if they are going to hold on to it, we got to be super careful about where it sits, because there can absolutely be scenarios where people cannot maintain the same quality of life in key stages of their financial life, and they're taking on risks that they shouldn't right at the time where things are as expensive as they've ever been.
What are the options, Brad, that you have when clients say that they've got a massive position? And by the way, if they have massive position, they're facing capital gains on it. Or actually, no, let's talk about a massive position, qualified and non-qualified. So Brad, if they've got a massive position in a 401k, there's a tax strategy called net unrealized appreciation that we help our clients with. Let's go into that. And then let's also talk about a non-qual concentrated position where we can help them draw income from that position. And then let's talk about the tax ramifications of capital gains. So Brad, let's cover all three. Start with NUA.
Well, I'm actually going to jump to the second one because I rarely, in my office here down in the San Francisco Bay Area, I rarely, if ever, have seen a concentrated position in a stock in a qualified account. I know that's fairly unique to the area that I'm at. I very rarely see a situation where people have a 401k with the same stock as their employer. I know that's very common up in Seattle with some of our planning offices up there. But the one that I do see a lot is people that have accidentally, and I kind of say that jokingly, accidentally accumulated a very large position in a non-qualified account. Now, for our listeners, non-qualified just means it's your after-tax dollars. It's not in an IRA. It's not in a Roth IRA. It's in an asset that as it's growing in value, you're accumulating a capital gain. As you're receiving dividends, you're paying 1099s, getting that 1099 every year. And in those cases, if people do have a concentrated position, one of the hardest things to walk them through is this risk that they're taking, because if they sell the asset, sometimes if they so much as look at the asset, they feel like they're paying a capital gain. So they feel like they just need to park it off to the side and kind of deal with the risk. And that's been hard because it is a tough thing to say, hey, yeah, go ahead and sell this position and incur a massive capital gain in a single year, or maybe spread it out over 2 or 3 years to get to a better risk adjusted allocation. So in a case where someone was going to hold on to that asset, one of my favorite techniques to explore with them is something called a covered call. Covered call, kind of an advanced planning technique, but for essentially what you're doing is you're generating your own dividend, and you can do this using options, specifically call options. Some listeners might be aware of what a call option is, but to summarize, it's basically a way of generating your own dividend on a concentrated stock position. You can do it with IRAs. I particularly like it with the after-tax dollars, because if someone is holding, say, Apple stock, let's say they have a $500,000 position in Apple stock, and they're just like, man, this is silly. Just has gone up too much. I just feel like I can't sell it yet. Well, if they're going to hold on to that position, we could start strapping that up with a covered call. And the call basically would generate an extra, usually a target somewhere between 3 and 6%, could be a lot higher on top of what that stock is doing anyway. So if that stock is up 4 or 5% in a single year, well, we could get an extra 3 to 6% target income from that position. Now, the way I think about this is actually not using the stock as a way to generate more cash flow for spending. I like to think of it as the stock is generating cash flow to pay its own capital gain. So if you think about that $500,000 position, if it has a very high capital gain on it, and they're like, I just can't stomach paying the taxes on it. Well, if we generated an extra, say, $25,000 of cash in that account via those call options, well, use that to pay the capital gains that are due. And now you can start slowly allocating to a more thoughtful position without the concern of taxes being simply the investment thesis there. So I really like that. As you can tell, it's something I've used for a couple of years now with my clients. It's been a fun one to introduce to people that kind of felt paralyzed.
833-707-3030. A lot of options in all these areas that Brian and Brad have talked about today, but it's really about you. How can these different areas that they talked about today, how does that affect you and your situation? That's what it's about. How can Decker Retirement help you get clarity into your retirement picture? Again, it's 833-707-3030. No cost for this, no obligation, no pressure whatsoever. 833-707-3030. Time to call them right now. Let's get started. 833-707-3030. Thanks for being with us today for Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. Enjoy the rest of your weekend. Brian back with more Safer Retirement Radio next weekend.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.